Okay, so good evening to all the participants. As we are moving forward in our program of Women Entrepreneurship Acceleration, your today's session is by Dr. Shikha. Ma'am is a very senior professor and chair for finance. Um, she is the best person you can find to discuss with your basics to the top level finance you want to discuss, from income statement to balance sheet to cash flows. And finally, you can have Kim, what are your small doubts which you always being curious about. तो कि कैश बैलेंस क्या है हमारे पास, हाउ से वी कैलकुलेट वेरियस पैरामीटर्स. तो मैम, I welcome you and thank you for accepting the invitation and coming for the session, and hand over it to you, ma'am.
Thanks a lot, Rahul. I'm really grateful and feel this as a privilege to
Mm,
take up this session here with Anveshan Foundation. And
yes.
I hope that my this 2 hours of session will be fruitful and learning for everyone as the audience here.
Yes, definitely, ma'am. Ma'am, our participants are basically most of them are at early stage startup, and few of
Mhm.
them even at the idea stage also.
Oh,
This is
that's
they are
fine.
under yeah, our women exploration programs which we are running at Anveshan, ma'am.
Mhm. That's fine. That's fine.
Yes.
So, and during the talk, like if any one of you has any query, then definitely we can deal that spontaneously.
Yeah. Thank you.
Shall I start? Shall I start
Yes.
sharing my screen?
Yes, ma'am. We can start, ma'am.
Okay. Give me a second to share my screen.
Ma'am, any issues with the screen sharing?
Uh, it's not getting downloaded. Just a second.
No problem. No problem.
Uh, may I know what is there visible on the screen?
Ma'am,
Is
it's your
the
mail, and on the top it's your PPT.
why
Ma'am,
it's
I think same has been downloaded also. Yes.
I'm trying to do it, but it's not.
Ma'am, please click on this. Click on this. I think.
I'm doing that, but I don't know why it's not opening. Do it once again.
Sure.
Why it's not downloading?
Mm. And you want me to share on, matlab, if you want, I can share on the WhatsApp also. Should I share the screen from here? You can share, forward the email to me.
Okay, I'm forwarding the mail,
Yes,
please, to me, and you can share it.
yes. Ma'am, I will just text you here in the chat box my ID.
Should I forward it to you on mail?
Yes, yes, ma'am. I'm just sharing my email ID. Yes, ma'am. It's in the chat box now.
I forwarded you, please check.
Sure, I'm just checking. I'm just checking, not received till now.
Your mail ID is Ram Sachdeva.
@ igdtuw.ac.in.
Yeah, sent it on that. Not received yet?
Just received it, ma'am.
Yeah, you can like on the full screen.
Yes, it's visible now.
Rahul, can you please put it on the full screen?
यस मैम, आपके पास एक अप्रूव वो आया होगा स्क्रीन के ऊपर, उसको आप यस कर लीजिए टू कंट्रोल द स्क्रीन.
Okay.
पॉपअप आया होगा फ्रॉम माय साइड.
Pop-up, it's not showing here.
यस मैम, अब आप नेक्स्ट कर सकते हैं इसे, आई थिंक.
Thank you, Rahul. Thanks a lot.
श्योर.
So, beginning with the financial accounting and the income statement or the balance sheet or the cash flow statement, it is very essential to first understand that what we talk about in accounts. So starting from the very basic and taking you to the higher level of this financial accounting thing, let us first try to understand that what does the accounting means. Accounting is nothing else but describing, or you can say recording, whatever transactions that is being going on in the business from day one till the end of the accounting cycle. So we all know that the accounting cycle that we need to follow for our business is 1st April, which ends on 31st March. I hope I'm clearly like audible to everyone here.
Yes,
Yes.
ma'am.
Yes.
Okay. Thank you. So whatever we are doing in our business, that needs to be recorded. And that recording part is done by the accounts department through maintaining of all the records in the form of journal, ledger, trial balance, and then taking it further to the developing of the statements. So here in this session, we will see that how the statements are being assessed, prepared, analyzed, understood, so that you are in a better position to assess your financial position of the business, and also you can compare it with your other competitors, right? Not able to change the slide, Rahul.
मैम आप ट्राई कीजिए एक बारी.
No, previously it was happening.
Sure, just give me 1 minute.
Now it is fine, I guess.
Sure. Okay.
So what is accounting? Accounting is the basic language of the business. Since, as we all know, you all are into your startup or going to start up your startup. So accounting, you need to understand that it is the language of the business. Since business is a separate entity, and you as being the person taking up the business, you are the separate entity, right? So whenever we talk about accounting, it is taken from the point of view of the business, not from the point of view of the entrepreneur or the person who is starting up the business. So whenever we are recording any sort of transaction in the business, we are taking that transaction from the point of view of business. Let's say, for example, any of the assets or the liabilities, we assess that asset or liability from the point of view of business, that what is the liability for the business, what is the asset for the business, not for the entrepreneur, or not for the you can say owner of the company. So whenever we are recording any of the transaction, whenever we are taking up any transaction in the business, that needs to be recorded from the perspective of the business. Not changing, Rahul, I guess. I don't know what is the problem. Yeah. So coming up to the definition, we can say that, as you can read out here, accounting is the art of recording, classifying, and summarizing. So what is the purpose of preparing accounts? We can clearly like understand from this definition given by American Institute of Certified and Public Accountants, that it is the art of recording. Whatever we are doing in the business, that needs to be recorded. We are recording it because we need to understand the performance of the business at the later stage, and that later stage performance can never be understood until and unless we have to record all the transactions that we are doing in the business. So any one of you can tell me here that what all transactions we usually do in the business. If you are having your own business or you are planning to start up your business, what all transactions you will be doing in your business? Anyone here?
Like sale, purchase, salary transfer.
Exactly.
So these all are transactions.
Yes, and many more. Salary,
Yeah.
this is one expense that you will be taking up. But other than that, there will be maybe office rent, maybe factory rent, maybe payment to the workers, maybe
Electricity
that
bills.
you have purchased. Yes, maybe you can say the electricity bills that you have paid, maybe some power consumption that you are paying off. There are n number of expenses that you will be meeting up So recording of all such transactions that you are doing in the business is the first step that we have to do, so that we can prepare certain summary at the later stage. And that summary is nothing else but developing your income statement, so that we can assess that what is the performance of the business if we compare the income and the expenses, right? But this summary, when we are preparing in the form of income and expenses, we need to have the total record of all the expenses that we have done in the business and all the incomes that we are getting in the business. So income in the form of sales, income in the form of any other, you can say, income that we have received. It can be certain interest, it can be certain commission, whatever. So the total income that we are receiving, as well as the total expenses that we are doing, we need to compare at the end, so that we can interpret certain, we can calculate certain profit or the losses that we are having in the business. But that is only possible when you have the proper record of all the expenses and all the incomes that we are getting in the business, right? So accounting is what? It starts with the recording of transaction from day 1, 1st April, till 31st March. That is the last working day of the financial year. Now, which all transactions we need to record? We need to record all the transactions that is of financial character. Financial character here means that any transaction which is done in terms of money, or which can be, you can say, valued in terms of money. Like, for example, you are doing sales, right? In any of the business, if you are doing sales can be the cash sales also, it can be the credit sales also. So for your understanding, in credit sales, we are not transacting any sort of cash, right? So cash is neither going out of the business, cash is not coming into the business, but still we are recording that sales, because sale is one, you can say, earning of the business, income of the business, where we can assess the value of sales in the terms of money. We are not doing the sales under credit sales in cash, but still we can measure that sales in terms of money, and that is the reason why we need to record it in the books of accounts.
Ma'am, can you please give me an example for this credit sale?
Credit sale here means, like, for example, you have sold certain goods, but for that your payment is still due, right? Suppose you have done the sales right now, and your sale, against that sale, the payment will be received after 15 days. Your vendor says that, okay, fine, when you will be, when I will be purchasing from you, I will be giving you the payment after 15 days or maybe 1 month. So that's...
So basically, whatever is invoiced within the month is the sale.
Yes.
Whether the payment is received or not.
Exactly. So this is why we need to say that any of the transaction which is of a financial character, that need to be recorded. Okay. So either it is cash sales. This is just an example. It happens with the purchases also. Maybe few of you must be undergoing with with your business with similar situations, that you are purchasing from your vendor, but you are paying to your vendor after a month, let's say. Right. So this is what? This is credit purchases. You have purchased it today. You will be receiving the material maybe in a week. But against that, you may have paid part payment right now, and the rest of the payment you will be doing maybe after a month. So that is a credit purchases. Right? So cash is not going out of the business. Cash is not coming into the business, but is still under the situation of credit sale or credit purchases, you are recording it. Why you are recording? Because it is a type of transaction that need to be recorded in the business, because it is of financial character. It determines your sales. It determines your purchases. So total sales, total purchases should be comprised of the total amount, whether it is cash or it is credit. I hope I'm making my point clear to you all.
Yeah, ma'am, very much. Yes, ma'am.
Okay. So at any point of time, if you have any doubt, any confusion, you can definitely ask it. So what is accounting? Accounting is the art of recording, summarizing the things, And this is only possible when we will be keep on recording all the transactions which is of financial character in our books of accounts. And these all transactions, at the end, we prepare a summary so that it gives us certain fruitful information. And that fruitful information is nothing else but your income statement, like assessing profit or loss of the business, or the balance sheet, that is assessing the assets and the liabilities of the business, right? So whatever exercise we are doing in our accounts, we are doing it ultimately for achieving this objective, that we should be having a fair knowledge about the performance of the business, as well as the financial, you can say, stability of the business, and how much is the assets and liabilities that the business carries at any point of time. Okay, so moving ahead with this.
आप पीपीटी में क्लिक कीजिएगा एक बारी. हाँ जी.
Moving ahead, objectives. Very briefly, I just need to tell you that this is all what we had discussed in the previous slides, that to ascertain why we are preparing financial accounting, because we need to ascertain the profit of the business. We need to know the financial position of the concern. Profitability by income statement, financial position by the balance sheet. And then the other objectives can be to have a systematic records so that we can have a check on the business properties. And obviously, if we have the systematic record, we can take certain rational decisions. So with this purpose, we need to prepare the, you can say, the whole account books. Accounting information system says that yes, whatever we are giving to this system of accounts in the form of transactions, maybe income, maybe expenses, maybe purchasing of certain assets, maybe meeting out certain liabilities, whatever information we are giving to this accounting system take that information as the input, process it. Process it means that we have certain designated, you can say, place of keeping the records. In the sense, incomes that need to be shown in the profit and loss account. Expenses that should go to the P&L account. Assets, any of the asset if the business is holding, that should go to the balance sheet. Any of the liabilities, that should go to the balance sheet. Cash related information that should be shown in the cash flow statement. So what is this? This is a processing of information, that how that information need to be recorded in the books, that is being followed by certain rules, certain principles, and following that rules and principles, we need to place that item in its respective position. This is what the processing means. And in the output, what we get? We get the financial statements. Financial statement comprised of 3 basic necessary statements. You must be aware about it. What is the income statement? What is the balance sheet? And what is the cash flow statement? These 3 are the basic financial statement that we should focus on. And why we do it? Because we need to have certain users here who will be using such information for their decision-making purposes. I hope this thing is pretty clear to everyone here.
Yes, ma'am, but what was the first one? Second was balance sheet. Third is cash flow. What was the first one?
Income,
First one is income statement, profit and loss account.
Okay, thank you.
We put in all the incomes and the expenses. Yeah? Shall I move ahead? Any doubts?
Hanji, hanji.
Okay. Now, very briefly, I just need to go through with this. Nature of financial accounting, which deals with the financial transactions. We take only the financial transactions. We record the financial transactions which has already occurred. Any transaction which has not occurred, or maybe you can say it is expected to happen in future, will not find its place in financial accounting, because we record only and only those transactions that has already occurred. Certain income that has occurred, we record it. Certain expenses that has occurred, we record it. Certain assets that we have in business, we record that only. Any asset which we are, you can say, expecting to buy in the future, we don't record that. So any transaction which has already occurred, any asset or liability that we already have, we record that only. And again, it is a process. Process in the sense that starting from the recording of transaction, we record it through journal entries, we then show it in the accounts, and then we prepare the financial statements. So this is the process that we need to follow. And each and every process is defined by certain rules, certain guidelines that we have to follow while preparing these records in the books of accounts. Right? So we'll talk about the rules also a little bit in the future session. I hope now you can understand the function and scope of financial accounting, that what we do in financial accounting, we record, we summarize, we interpret the data, interpret in the sense, whatever the profit and loss account that we have prepared, what is the, you can say profit position or the loss position for the business. We need to interpret that. We need to understand that if, let's say, for example, last year profit was higher and this year profit is less. Why this year profit is less? We need to go back to the income statement of last year and assess that what was the issue. Whether the cost has increased or the income has declined, that resulted into reduced profit for this year. But that is only possible once we have the proper record of all the, you can say, all the transactions that we had in the future, so that we had a proper summary of income statement in the form of expenses and incomes. Until and unless we have the full information depicted in the income statement, we will not be able to assess the situation clearly. So all the transactions should be recorded, should be posted in the income statement, so that we can very well in a position to analyze and interpret that what does our income statement says, what does our balance sheet says. This is the purpose of functions and scope of, you can say, financial accounting. Now, moving ahead, who all are the users? Obviously, you all must be knowing this, that accounting information is being utilized by internal or the external, both the parties. If we consider the internal parties, obviously it is the owner or the management or the employees that is attached with the business as a stakeholder, and also the external parties. External party here means anyone who is from outside the organization, which can be the investor, which can be the lender, which can be any of the legal bodies or the government. Maybe at times the customers or the suppliers, they need to decide that whether this particular, you can say, company is good to do the business with or not. Or any of the prospective investor from the general public who may be interested in your company for the investment. So any of the party which can be internally related or externally related may be interested in your this financial statements or the accounting information, because they have to take their own certain decisions. Maybe as the customer, maybe as the owner, maybe as the employee, maybe as the vendor, they need to take their own decision that whether I should do business with this particular company or not, whether I should invest in this particular company or not, whether the you can say the internal management, they have to take certain decisions. So they must be interested in the accounting information, that how we can take up this particular decision, or what ways we need to move ahead with this decision. So each and every party, concerned party, or the stakeholders that we call, have their own purpose of looking at into the accounting information for their respective decision making. I hope bookkeeping you all must be aware about. So I'm not touching this much. Yes, it's my assumption. I hope bookkeeping is known to you all.
Yes, ma'am.
Now, giving you a brief information about accounting principles, how do we do the accounting process, and then we'll discuss further on the statements. So accounting principles, as we all know, that in India, we follow GAAP, that is generally accepted accounting principles. So this generally accepted accounting principle is prepared and approved by ICI, the Institute of Chartered Accountants of India, and they are the responsible body for framing up the principle that how the Indian companies or the businesses, they will be taking up their you can say presentation of accounting information. So whatever information they give, the businesses give, they need to follow the rules or the guidelines that is being shared by ICAI, right? So whenever we are preparing the books of accounts, we need to have this information, that how we need to present this data, how we need to prepare the accounts, how we need to prepare financial statements, because each and every item has its own rule, each and every item has its own place of, you can say, position of placement. You cannot put income anywhere in the statement. You cannot put expenses anywhere in the statement. You cannot put assets anywhere. Like, there is a format of income statement, there is a format of balance sheet that you need to follow. And how do we know that format? We know that format with the help of these accounting principles, like the rules, the guidelines that is given to the businesses, that you have to follow these pattern, these rules, to show your information in your books of accounts. What is the need of it? Anyone who can tell me what is the need of it? Why these rules are defined? What is the purpose? Anyone here?
Ma'am, for the standardization of accounting.
Okay, yes. And?
The major reason being to keep a track of the things going on.
Yes, very good.
So that we can have it a clean audit.
Yes.
And
exactly.
all follow the universal method so that comparison and the analysis is easy.
Yes, good, good. All are right. See, what happens is when we define certain rules, rules means that everyone need to follow it, right? So what is the major benefit that we need, that comes out of that rule is uniformity, right? Suppose there is no uniformity in preparing the income statement, okay? What will happen? Each and every business organization will have their own standards, will have their own way of presenting the data. Now, how one company can be compared with the other company if there is no standardized format? So in order to make the format standardized, or in order to make the format comparable with each other, there is need to have certain rules, certain guidelines to prepare that statement. And this is the reason why we need to say that, yes, income, okay, the sales income has to be shown here. The other income need to be shown here. All the expenses, okay, you need to show the expenses here. This is the place for showing expenses. All the assets, you have assets column in the balance sheet. You need to show all your assets over there. The purpose of it is very clear, that when you are showing these assets, these liabilities, these incomes, or the expenses in your financial statements, it will be common for everyone, right? Just a second. Common for everyone here means that it is a generally accepted format. Everyone will be showing the income in the income statement as the form of sales, as the first item of income. Everyone will be showing all the incomes together along with the sales, right? Then comes the expenses. All the expenses will be shown at its respective place. And I know that if I have to check the profit for a particular company, where I have to look for. It's not like this, that in financial statements, I'm just searching out where the profit is being mentioned. No, profit has its own place. Earnings has its own place where I have to look for it. So we understand the statement very clearly if we have to follow a standardized format. So what does this format says? This format simply says that, okay, this is the standardized format every firm should follow so that it will be easy and you can say understandable by any, you can say any person who is maybe not concerned with accounting background. Like for example, maybe you guys running your businesses, maybe certain people are here who are still not able to follow that what does the account says, but at least looking at the format you will be able to understand, okay, says acha, for this company if I have to look for sales, I have to look for this place, right? If for this particular company I have to look for assets, so I have to go to balance sheet and look at the asset side, I'll get the asset. So this is the benefit of having certain rules and regulations, certain standard format, so that it can be easily understandable, and of course, it can be comparable from one company to the other company. Otherwise, if there is no certain format, then it will become very difficult for companies to understand that what is the comparison between two or more companies. So it gives you a common, you can say, format. It gives you an understandable format so that you can understand the language of the business in a better way. Now, moving ahead with this gap, gap is what? It is generally accepted accounting principle, which need to be followed by each and every organization who is running their own business in the Indian economy, right? These all things we have already discussed, that it gives you can say a standardized format. It gives you you can say common understandable format. It is easy for the external parties or the internal parties to take up their decision by looking at that you can say generalized format of accounts, and it becomes easy for any of the party to understand that. Now, what does this gap comprise of? It is comprised of certain principles. It is comprised of certain accounting standards. Let me take you to the principles. Principles says what? It says the very basic thing of preparing the accounts, that business is a separate entity. We do business following this concept that it is for the longer term. Right. We do not run the business thinking that, okay, I will close down the business in a year or two. No, we do the business, we take it up as the startup, considering that it will go for a longer time period. We record the transactions in the books of accounts, accepting that business is a separate entity from the owner. Then we follow the accounting period concept. Accounting period concept means that whenever we are preparing the books of accounts, we need to divide that into the financial year. Financial year means that the time period for the account books will start from 1st April and will end up on 31st March. So whenever we are preparing books of accounts, we have to follow this pattern that, okay, new book will start from 1st April and it will end on 31st March. And on next 1st April, we'll be starting another new books. So this is the principle as given by the concerned authorities, that you have to follow this, right? That is said money measurement concept. Money measurement means anything and everything that is measured in terms of money should be included in the books of accounts if that related transaction is happening in the business. Then it says that cost concept. We have to, when we are mentioning our assets in the business, we have to follow the cost concept or the fair value system. Fair value system or the cost concept means that at what price you have acquired the asset, you need to mention that, or the present fair market price of the asset. Whichever you can say that the present market valuation of your asset should be reflected in your balance sheet. Then dual aspect. Dual aspect says every debit and credit should have simultaneous entry. I hope this dual entry concept is you all are aware about it. Yes? Dual aspect says debit and the credit aspect, that each and every transaction, if recorded in the business, once it should be debit And on the other hand, it should have a credit effect. Okay, if not there, I'll come back to that point. Then matching concept says at the end, you need to match your income with your expenses. And then revenue recognition says until and unless it is, you can say, I got some message. Megha. Which concept, Megha? Going aspect. Okay. Going aspect says that whenever you are preparing the books of accounts, you prepare it with the perspective that the business will go on for the longer time period. Longer time period means you value your assets accordingly, you define your responsibilities or the liabilities accordingly for the business, considering that this business will be there for the longer time period. We do not prepare the books of accounts with this respect that, okay, this business was closed down in the near future. This is what the going concern concept says. And with this basis, we need to mention the assets, we need to mention the liabilities, and we need to mention that, okay, this is the debtor for the business, this is the creditor for the business. Why? Because you know that today I'm doing the transaction and maybe I will be paid later after 1 month or 2 months, or I have to pay maybe after 1 month or 2 months. Why we are taking such transaction? Because we know the business is a going concern. It will go on for a longer time period. Yes. Then, moving ahead to the other principles, it says, I missed out something. Realization concept. Okay. Yeah. Realization concept says that whenever you are preparing your books of accounts, you are not allowed to mention any of the sales until and unless it has been invoiced. Right? Means until and unless you have any legal claim on your supplier or on your vendor that, yes, this is the order, I have delivered it to you or I have given it to you, and you are not having any legal claim on that payment, till that point, you are not suggested to put any item as on the you can say on the assumption basis in your books of accounts. As I said in the previous slides also, that until and unless that transaction has already occurred, you are not allowed to put up that transaction in your books of accounts. So same thing applies here also, that at times it happens with sales, that you got the order and you have put it in the books of accounts as a sales, but that sales are not actually invoiced, or that sale, for that sale you have not developed any legal, you can say, claim. Now suppose if you have not developed any legal claim on that transaction, and let's say your order gets cancelled maybe at the later stage, then unnecessarily your sales amount got hiked up. You have increased your sales amount because of that transaction, which later on got cancelled. Right? So the only point here need to be considered is until and unless you have legal claim for that sales amount, you should not be mentioning it under your sales. See, नुकसान आपका है, क्योंकि once you have added up that amount in the sales, you have shown your sales, you have increased your sales with that amount. And let's say if that sales does not occur, then you need to reduce down your sales amount with that amount. But in the meantime, suppose you have calculated your profit, then your profit will unnecessarily show the increased income, which is actually not there. Right? I hope this is clear now. Yeah. See, Rachna, this is what I was explaining, that yeah, of course, at times we to save GST, clients or vendor ask for the thing. But see, it happens that you need to safeguard yourself, right? See, there are many things happening around, but how you can be true to your accounting records, that you have to define, that which way you need to take your business transactions, right? See, whenever you are putting up any of the transaction in your books of accounts, you need to be sure enough that that has been properly, you can say, documented. If you are not doing so, it may lead to certain problem for you in the near future, right? Medha, which point you are asking me to define again? Can you please tell me which point you are asking me again? Money measurement. Okay. Money measurement simply says that whatever you are showing in your books of accounts, that should have the capacity of being measured in terms of money. This is what the financial character we were talking about in the initial stage of the lecture, that whenever we are putting up any information in the books of accounts, either it should happen in the form of cash incoming or cash outgoing, or it should be in the capacity of being measured in terms of money. Like, for example, as I give you the example of credit sales or the credit purchases. So credit sales or the credit purchases, in this, there is no cash transactions occurring. Neither you are receiving cash nor you are paying cash, right? But still you show it in your books of accounts. Why? As under purchases or as under sales, because it is having the capacity of being measured in terms of money. So any transaction which has this capacity of being measured in terms of money should find its place in your books of accounts. Okay. See, credit and debit. Yes, of course, you are right. Partially that credit and debit should match. Of course, it should match. But how it will be going to affect, like we cannot say it should be 0, 0. How it is going to be reflected in the books of accounts, that we'll take up a little bit later in the session right now, when we will be discussing the financial statements. Okay. So allow me to reach that point, and then it will be more clear, I assume. Right? So moving ahead with this to the other principle, which talks about that whenever you are preparing your books of accounts, you should follow a little bit conservative approach. Conservative in the sense, you should invite all the, you can say, losses, expected losses with all your hands. But yes, you should be a little bit conservative when you talk about your profits. Means whenever there is expected losses, just try to incorporate those expected losses with the help of the provisions, like keep aside certain part of your income for the expected losses, as we used to do in the form of bad debts, right? When we are expecting any losses in the form of bad debts, what we do, we usually try to keep a certain amount of income for meeting up that bad debt losses. So when you are, you can say you are expecting any losses, be prepared for that losses, which will come up in future. But if you are expecting any profits, please don't, you can say, do any accommodation of the expected profits in your books of accounts until and unless it is already received. The crux is this, that profits or the incomes, until and unless it is received, will not be entertained in books of account. But yes, any of the losses that we are expecting to happen in future, we may you can say, prepare ourselves for meeting out those losses. Creating provisions is a part of that only, that we are preparing ourselves for the expected losses. For in sense, for example, discount provisions, if we prepare, or we prepare the provision for bad debts, that we are expecting certain bad debts, we are keeping a part of income for meeting out the bad debt losses. So it is that losses we are preparing ourselves for this particular, under this particular principle only. Then convention of consistency, it says that you need to like follow the consistent policy in your books of accounts. Consistent policy means it should not be keep on changing again and again. The way you are preparing your books of accounts, the policy that you are following, that should be consistent for a longer time period. It should not be changing frequently. Full disclosure, obviously, that is what we were discussing previously also, that whatever your books of accounts says, it should reflect the full information of your transactions. You should not be hiding any of the information. You should be providing thorough information of your business in your books of accounts, so that your profit and loss should be reflected properly, and your financial position in the form of assets and liabilities should also be reflected properly. And then comes your convention of materiality. Convention of materiality says that whenever you are preparing your books of accounts, you should tell whatever is required by the stakeholders, maybe in your books of accounts, or maybe with the form of attached notes. So I hope you know what is the notes to accounts. Notes to accounts means whatever you are showing in your financial statements, the explanation of that how that amount is being calculated, whatever you are showing in your financial statements, how that amount is being calculated, you need to show, you need to give the explanation of that with the help of notes to accounts. Whatever you are not able to mention in your financial statements, but yes, you need to convey it to your stakeholders, that should be aligned in the notes to accounts. I'm not going into detail with this accounting standard board, because you all know ICAI, they have set up this accounting standard board, and the responsibility of this is to define the principles, the rules that we need to follow. Yes, one thing I just need to touch over here is the International Financial Reporting Standards. It is what? It is the International Financial Reporting Standards are the, you can assume it to be the international standards which is globally accepted. And India is one of the country who has not accepted the global standards, but we call it as the converged form. Converged form means we have our own Indian GAAP, Indian generally accepted accounting principle, and we have framed this generally accepted accounting principle with the New Companies Act 2013. And once it has been implemented, we have changed our own rules and regulations also in line with International Financial Reporting Standard, so that there should not be much difference in what international standard says and what our Indian GAAP says. So Indian GAAP is the Indian set of rules and regulations that we need to follow, and IFRS, that is International Financial Reporting Standard, it tells us about the globally accepted financial reporting standards. So what we are trying with the Indian GAAP is, we are trying to reduce down the IFRS and Indian GAAP differences.
So what is the difference between two?
There is a lot many point which is difference, like how we show the provisions, how we put up the, you can say, depreciation item. There is certain points of difference, but see, the approach is this, that previously when there was Companies Act 1956, at that time, whatever rules has been framed, we kept on amending that rules. And now after the depression in 2008, it has been realize that no, those rules and regulation need to be defined again in order to you can say have the standards which can be followed in the present scenario with the LPG policy. Like we have globalized firms, we have increased the standard of businesses in the Indian economy. So those old conventions and rules are not pretty much adaptable. So when we have launched this Companies Act 2013, after that, a new set of rules has also been framed up. And this new set of rules gives you, you can say, the better standards. It gives you the better way of presenting your, and also more rigorous and stricter way of presenting your information. And what this new set of rules has followed, they try to follow this IFRS as much as possible. But since each and every country has its own customs, its own legal requirements, its own differences. So, what this gap has done is they have tried to follow maximum whatever IFRS wants from the different countries. But going that in detail, it will take another session. I hope, if possible, I can talk and take up another session where we can talk on this IFRS and what the Indian gap says. Because there are many points which are similar, but yes, there are a few points which are different too.
So if I'm exporting, so is there anything which I need to concern? You're talking about like duties and all?
Not exactly duties, but yes, the valuation of goods and how you need to present that in your books of account, that is a little bit, you can say, affected with it.
Okay.
Okay? So if the
So that is like you're talking about the forex account and all.
exactly.
Okay, that I know. Thank you.
So this is the picture that I wanted to share with you all. But I don't think so. We should go much in detail with it. This we have already discussed. So this is the Indian accounting standards as converged. Converged here means that this is the status of our Indian standards, that we are not exactly following IFRS, but yes, we have changed a little bit in that set of rules and we have adopted our own Indian gap. So we call it as the converged, you can say, gap. Converged gap, we can say it, not exactly IFRS. And it has been implemented in India with 2015-16, you can say, financial year. So from 15-16, we have tried to adopt this new set of rules and regulations with the new IND-AS, that is Indian Accounting Standards. And from 2015-16, we have we are trying to include more and more companies in this set of new rules. Now, phases, I don't think so it will be required here. Now, coming to the basic of, you can say, financial statements. This is what previously has also been asked. So what is accounting equation? This is the whole crux of your accounting, which says that all your economic resources is equal to economic claims, which means that economic resources are the you can say assets that we have in the business, and economic claims are liabilities or the equities that we have, right? So when we talk about assets, it means anything which belongs to the business, and liabilities or the equity means which the business is liable to pay off to the outside parties, right? Moving ahead, you all know that assets, when we talk about, this is something which belongs to the business. But yes, we need to be very careful while assessing the business assets, because assets need to be taken from the point of view of the business, not from the point of view of the owner. So the ones who are trying to take up their startups in the near future, they should keep this thing in mind, that assets are you can say accounted from the point of view of business. owner is a separate entity as we have seen in the previous accounts, account discussion, right? So now assets can be of two types, right? Majorly, if we define assets, it can be the current assets and the fixed assets. Current assets are the ones which you can say which can be easily converted into cash within a span of 1 year. This is the very basic understanding that we follow in accounts. And fixed assets are the ones which are having you can say more longer life, the one which we need more than 1 year to dilute, or which when purchased have been purchased to be there in the business for the longer period of time. Then it can be classified into tangible or intangible assets. Tangible are the ones which can be seen physically, but intangible are the ones which we cannot see, but yes, it has its financial value. So like goodwill is one example which we can very easily you can say consider under intangible asset, that yes, goodwill is you can say physically not present with the asset or the businesses, but yes, it can be valued. It has certain financial value, which if required, we need to show it in the books of accounts under assets in the balance sheet. I hope you all are here with me till this point.
Yes, ma'am.
Now, moving ahead with the liabilities. Liabilities are, you all know, from the business point of view, if we see, then liabilities is you can say whatever the owings you need to pay off to the external parties. So in the case of liabilities also, as we can see, there are current and the you can say long-term liabilities. Current liabilities, again, we follow the same process, that any liability which need to be paid within the span of 1 year, that includes the that should be included under current liabilities. Long-term liabilities which need to be paid off in more than 1 year's time. But again, the liability is from the perspective of the business, not from the perspective of the owner. So any business, when we need to mention the liabilities, we need to assess that to whom the business need to pay, not to whom the owner need to pay. Now, coming to very important aspect of liability, that is equity. So anyone who can throw some light on this, what is equity here? Anyone? No?
Can you repeat
Equity
that?
is buying a part of the business.
Mm-hmm.
Shares in the business, I mean.
Mm-hmm.
Equity can be someone's investment in your business.
It is
Or
the stake of a business from by the either by co-founder or by investor.
Mm-hmm. Good.
you take a loan or something from the other party.
No, this is a very common perception that we follow, but it is actually not right. We need to understand here that what is equity? Equity for any business is a liability towards its owner, right? To be very specific, that it is the liability towards owner, right? When the owner has invested certain amount in the business, okay, that amount invested by the owner in the business is a part of equity. Okay? Now, suppose I am starting up a business, right? And I have invested my 1 lakh rupees in the business, or maybe some assets I have brought into the business, right? This 1 lakh rupee will become a liability for the business. Agree? I hope you all agree with me.
Yeah.
Yes.
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 Now,
Yes.
at the same time, it will be counted as equity. Why? Because the business has this liability of paying 1 lakh rupees back to the owner, because the owner 1 lakh rupees is being invested in the business. Now you need to consider, when you try to understand this equity, you need to consider that business is a separate entity, owner is a separate entity. Business has its own assets and liability apart from the owner. So owner has given 1 lakh rupees to the business for its functions, right? So when business is running its function, it is utilizing that 1 lakh rupee given by the owner. Now, since owner is different, and when we talk about the person from whom we have taken debt is a separate, you can say, liability for the business. So one part of capital is coming in the business from the owner, and the other part is coming from the person who has provided you the debt, right? So for the person from whom you have taken debt, to that person, you will be paying off certain interest in return, right? And that is the reason the other person has given you the debt, to earn certain income on it. So for that debt, you will be paying off the interest, and the thing will be settled there. Interest pay kara, debt ka amount pay kara, and your account will be settled with that person, right? But what about the person who has invested in the business as being the owner? For that, you will be assessing that how much is the share of that owner in the business. Against that, the equity will be calculated. Right? So here comes the role of the valuation of the business. Here comes the role that how much is the owner invested in the business, and accordingly, the equity valuation will be done. Right? And also, you apply this equity concept when you are having venture capitalists in your business, or you are having angel investor in your business. Why we used to say that this venture capitalist has come into the business and diluted the equity? We have diluted the share. Yes, you must have heard about these terms.
Yes, ma'am.
Yes.
He might have purchased the shares or invested some money in the business.
Yes, this is the two different aspect of looking at into the same problem. Now, try to understand this. Suppose XYZ company is there, and that XYZ company is issuing certain shares, right? You must have heard about Adani's FPO these days. I hope you all...
Yes, FPOs.
Yeah.
Yes, the debacle where he has stopped, and he is going to return all the money.
Exactly. But that has been cancelled. Now, our concern is that Adani is raising fund from the market with the help of FPOs, right? Now, what FPOs are? This FPO is the capital which he is trying to raise from the market by issuing certain shares. So for that company, that shares will give him certain equity, right? It will be liability for the firm, for the company, to pay off that equity amount to the respective owners. Agree?
That is whenever they want it back.
Yes. See, once the shares are being listed in the stock exchange, then the company will not be in the scene, and you can say the shares will be traded in the stock market, and you can sell and purchase accordingly, right?
Okay.
Yeah. So उसमें ना कंपनी के पास पैसा जाएगा, ना कंपनी को पैसा देना है. Once the share are being floated in the market, company has got its initial capital. Now the company will be utilizing that capital, and the share are being listed in the stock exchanges. Now whosoever wants to trade that share, they can keep on purchasing and selling. Now the company will not be in the picture in that case. Right. Coming back to equity, equity is whatever capital owner has invested in the business, plus there is one more thing that need to be considered here, that you all must have heard about this term retained earning, reserves of the business. Yes? Do you know about that concept? Anyone? No?
Reserves means what they keep, I mean, to keep as an backup money.
Yes. Reserves means technically what we mean by
For the
reserves
security
is,
they keep.
see, by reserves, what we generally mean is that we are keeping certain part of our profits, which is not distributed to the owners. What the company usually do, whatever is the profit that is being earned, it goes to the owners. The profit belongs to the owners. I hope you all understand that fact, that whatever profit is being earned by the business, that belongs to the owner, right? In the case of companies also, that belongs to the owner. And owner is what? Owner is the shareholders.
Yes.
So it becomes the responsibility of the company management that whatever profit is being earned by the company, they need to be paid back to the shareholders in the form of dividends, right? So whenever you are paying dividends, you are parting of your profit, right? This is the decision with the in the hands of the company, that how much out of profit, how much they want to give it to the shareholders. Like suppose if each share is earning 10 rupees as the profit, so maybe the company can take up this decision. Okay, fine, we will give out of this 10 rupee, we will give 5 rupee as the dividend, and rest 5 we will retain in the company, that may be further used to invest in the company for its development, right? So 5 rupees that has already been given to the company, given to the owner, that has already been distributed, right? That will be shown in the books as the dividend paid. But the amount which has not been given as the dividend, that will be shown as the liability in the reserves. And it will become the part of equity. Why? Because it has not been distributed, but yes, that amount which is being reflected in the reserves or in the retained earnings, that is still belonging to the shareholders only. You cannot utilize it. Apart from certain usage, you cannot utilize that amount without the permission of the shareholders. You need to disclose the purpose. You need to disclose that this is the amount of the retained earning of the reserves, and you will be utilizing this amount for this particular purpose. You cannot utilize it without approval of the shareholders or without taking permission from that. So equity is what? Coming
One small
again.
question.
Yes, ma'am.
Yeah. So like there are many companies who are not sharing their dividend at all. So what is that? So like ITC gives the share
Yes.
dividends, but
Yes.
most of the infotech companies are not doing. So that money is a still a liability?
Yes, of course, it is a liability, because if they are not distributing the profit, see, profit will be having two parts. One, the distributed profit, which has given back to the shareholders. Other is the undistributed profit, which has not been given back to the shareholders, but being retained by the company. So whenever profit is being retained by the company, it will be utilized in the future for the development purpose. Which we call it as flying back of profits. Flying back of profits means profit earned by the company. That profit has been retained by the company, not given it to the shareholders. And yes, later this profit will be further utilized in the business for the investment purpose, so that the business can have further gains, which can ultimately benefit the shareholders only. Right? So that is also a, you can say, a part of equity only. Okay? मैंने आपको, let's say, for example, I have given you 100 rupees to keep it safely. And I said that, okay, fine, I'll take this 100 rupees back once I will be in need. Right? So will that 100 rupees belong to you? No, definitely not. I can take it at any point of time. The same happens with the reserves also, retained earnings also. That this retained earning is the amount which need to be given to the shareholders. But yes, with the decision of the management, it has not been distributed. So it is still belonging to the shareholders. But we are keeping it so that we can utilize that amount as capital in the business. Or the other way out is that we can take that amount for issuing for the equity shares, bonus shares to the shareholders. So that is another way of giving, you can say, benefit of the retained earnings to the shareholders. Right. So equity is what? Coming back again to the basic concept that we were discussing, that equity is what? Equity is the amount of capital that is being contributed by the owner, plus if any of the reserves is existing in the business, then also that reserve will be considered as the part of equity. So equity is nothing else but the total belonging of the shareholders in the company, which the business has to pay back to its owners. I hope I have made this a bit clear.
Yes, ma'am.
So moving ahead, you can see here, equity includes what? We include the share capital, of course, the amount of capital that we have raised from the owners, that forms the share capital. It is included in equity. Securities premium, if we have, you can say, collected any premium from the equity holders on the shares, that forms the equity. And the retained earnings, like any of the earnings that we have not given to the shareholders, but it should have been paid, that forms a part of equity. I hope this is clear, or I should go in a little bit more detail with it.
It's clear, ma'am. Let's go
Okay.
forward.
Okay, fine. With this, there is a elaborated accounting equation that we call as that assets is equal to liabilities plus capital plus revenue minus expenses minus drawings. Why so? We all know that assets is equal to all liabilities plus capital. On one side, we show the assets. On the other side, we show the liabilities and the capital. With every revenue, right? With every revenue, the asset increases. With every expenses, the asset decreases, right? And this is the basic you can say, concept we utilize for showing the balance sheet statement. Okay. So,
Ma'am, could you please repeat the last sentence you said? With every revenue, the asset increases.
yes.
And
See, it's very logical. If we are having income, what will be the impact of that income on the profit?
It increases.
It increases. Okay. If we have certain expenses, what is the impact of that expenses on the profit?
Decreases.
It decreases. Now, understand it with this concept that with every increase in the profit, the equity will increase. Yes?
Yes.
And with every decrease in the profit, equity will decrease.
Right.
No? So, with every revenue which is being adding up in the business, the equity increases. With every, you can say, expenses that is happening in the business, the equity decreases.
Decreases.
True?
Okay.
Yeah.
Yes.
So this is the basic funda of analyzing the relation of assets, liabilities, and revenue, expenses, capital. Okay. Now, coming to the financial statements. How many of you know the how to prepare the financial statements? Anyone? I just need to know what is your basic understanding about financial statements. Then
Ma'am, being a doctor, I have no idea, so these are very basic for me.
Okay.
It's like
Uh,
basically maintaining the
you know the
leisure.
basics what we studied in commerce on 11th and 12th in school time. This all has been covered up, I believe, in the school time.
Yeah, this would have been then a brief revision.
So it's basically the leisures to be maintained and what is debited, what is credited, that is on a one statement.
Yes, yes. So see, now I'll tell you, I'll skip this T format. See, whenever we are following the accounting income statement or the balance sheet or the cash flow, what we need to do is, there are two patterns of maintaining the records. One is the T format, other is the, you can say, vertical format. So when we talk about the T format or the horizontal format, let me take you to the format. This is the T format. You can see the T type of a structure. This is the T format of preparing income statement, where on one side you put up all the incomes. As you can see, sales is written there, right? And on the left side, you put up all the expenses. Expenses in the sense, whatever you can say you are spending in the business in order to have your operating, you can say, having your operations, then you need to compare it. Comparison of income and expenses will give you your profits, at how much your income is exceeding over your expenses, right? So this is the horizontal format. Now taking you to the vertical format. I'm not going into detail with it because you have already discussed these things. Now see, the very basic, you can say, flow of income statement is in the vertical format is that we start with the sales, that whatever revenue we are generating with the help of sales, we take that as the first item, right? And then in sales, we add up the other incomes, whatever other incomes we are earning other than sales. So beyond sales, maybe we can earn certain interest. Other than that, we can have certain commissions, right? Certain other, you can say, royalties, whatever. So in business, whatever we are earning other than sales, that will be added up. So we have two you can say, sources of income. One is majorly for any of the business. One is the sales, other is the other incomes other than sales. So this is the total income. Now, from that total income, we need to reduce down the different, you can say, level of expenses. Like you can see, after total income, I have written less COGS, COGS. COGS is cost of goods sold. So now, what is this cost of goods sold? Cost of goods sold means that whatever you are selling, what is the manufacturing cost for that lot of goods? So आपकी सर्विसेज है या आपका फिजिकल प्रोडक्शन हो रहा है, whatever you are into, how much is that goods or the services costing you? Where maybe you can include your opening stock if you have, whatever purchases you have done, whatever other direct expenses you have incurred. Direct expenses means any type of expense which is directly involved into production, which is contributing towards producing that particular unit, will be
So
taken.
this is excluding markups and profits.
Yeah. So all the indirect expenses, as you can see here, when we'll see this, the lines after gross profit. So we are not taking up here in COGS calculation, we are not taking up selling and general administrative expenses. This we'll take up later. For now, we are taking only the expenses which is directly related with production, so that we can calculate that how much is the value of goods that we have sold, right? Considering all the direct expenses which is directly involved. Let's say, for example, raw materials. Let's say, for example, that wages that you are paying. Maybe, for example, the power consumption, maybe the fuel consumption that you are putting up in your machine. So these all will contribute towards your direct expenses and will become the part of your COGS, right? Then once you have already deducted your total income with your COGS, the leftover part will become your gross profit. This gross profit is nothing else but part of your income, which is depicting the sales minus all the direct expenses related to production. But why we are calling it gross profit? Because it is not the exact profit that we should take up for the financial year. Yet we need to further include many other expenses which we have not taken in the direct expenses head.
Ma'am, I have a small query here. Can I ask?
Yes.
Yes. In the costs, when you say, can you elaborate contribution 1 and contribution 2, which we usually, listen over Shark Tank? What is contribution 1 and contribution 2?
Ma'am, give me a little bit of time. Let me first finish off with this flow of a statement, right? Then we'll come to that.
Fine.
Okay.
Fine.
So now what we need to do here is, let me first finish off with this flow of income statement, because if we go to that point, that will take another 5-7 minutes for me to explain, right? So let us first understand that what does the income statement talks about and how does we need to calculate, and then I'll come back to that point. So see, when we are deducting from this total income, when we have deducted COGS, we got the gross profit. And as I was explaining, that this gross profit is not the exact profit that we need to quote for any of the financial year, because we have not considered the other selling expenses or the advertising expenses or the research and development expenses, etc. here. So what we will do, out of this gross profit, we need to reduce down further these expenses. Whatever you are spending in the selling expenses, whatever you are spending as the administrative expenses, you have to reduce down those expenses. Then coming to the advertising and marketing expenses, whatever you are spending in this area, you need to reduce down. Then research and development. And now what you are getting will become your EBITDA. EBITDA is your earning before interest, tax, depreciation, and amortization. So whatever earning you are getting in the form of EBITDA, it means that you have considered or you have deducted all your direct expenses which were involved in production. You have deducted all your indirect expenses that is being incurred in the operations of the business. Now, whatever left is, you have not considered depreciation till yet. You have not considered any part of interest that you will be paying. And of course, the tax part. So after getting your EBITDA, what you need to do, you need to calculate your depreciation or any of the amortization expenses that you are having. So depreciation, when we will reduce from this earning, we will get earning before interest and tax. EBIT is considered to be one parameter that can be assessed as the you can say profitability of the business. Through this EBIT, we can analyze any of the income statement. We can assess the performance of the business, because after this, whatever is left is the interest and the tax. Let me tell you that interest is one of the, you can say, expense for which the business firms gets the leverage. Yes, leverage in the sense that anyone who wants to elaborate on this leverage point with the debt, if anyone has any idea about it. Anyone? No? Interest is being paid to the debt capital. As we were discussing under equity, that the capital can come from two sources. One is the debt, other is the, you can say, equity, right? So debt is the borrowed fund for which you need to pay the interest, and you need to pay the principal amount also on the regular basis. ठीक है? So जिसको हम उधार कहते हैं, borrowed fund है. Borrowed fund पे हमें interest pay करना होता है. That interest amount is being considered as an expense for the business, right? So now you can see here that since we are considering this interest as the expense for the business, so the more you pay interest, the less will be the amount of earning for which you need to charge tax. I hope you can relate this. More interest, less earning for tax. Less interest, more earning for tax. Yes? Are you able to relate?
Can you please give an example, because I'm still not clear.
Let me take up the amount here. Now suppose my EBIT is 1 lakh rupees. Fine? And there is no debt capital. My EBIT is 1 lakh rupees and there is no debt capital. No debt capital means I don't have any debt. I don't have any capital which is raised from debt. So I don't have to pay interest. And let's say the corporate tax is 30%. So how much will be my tax? Anyone? How much will be my tax? Uh,
3,000.
How much?
30% of 1 lakh.
Exactly. It will be 30% of 1 lakh.
1 lakh, which will be 30,000.
Exactly. It will be 30,000. How we have calculated it? You can see it in the flow of income statement. I have mentioned that earning before interest and tax. After that, we have to reduce down the interest. And then comes the earning before tax. And on this earning before tax, I have to charge my tax. So whatever corporate tax we need to pay, that we need to calculate on earning before tax, right? And for calculating earning before tax, we need to first reduce down the interest amount. Now, as in my example, I have taken up that EBIT for my company is, let's say, 1 lakh. And I don't have any debt capital. If there is no debt capital, then of course, there will be no interest amount. No interest amount means that my EBIT will become my earnings before tax, and I have to charge 30% tax on that 1 lakh rupees, right? Which will amount to 30,000 as the tax amount, right? Now, in the same EBIT, suppose if I have debt capital for which I need to pay 20,000 as the interest. Now, what will happen? EBIT 1 lakh minus 20,000 as interest. So this will give me earning before tax of 80,000. Now I have to pay 30,000 tax. Sorry,
30% of 80,000.
Yeah, of 80,000. So what is happening here? My tax amount has reduced down. And why it has reduced down? Because I have taken up debt form of capital.
Now this interest deduction, is it if we borrow from anybody or it has to be borrowed only from bank?
No, it can be any debt that you have taken and you're showing it in your books of accounts as the debt that you have taken, and you need to pay interest on that.
Okay, right.
Right? So once you are showing that this is the debt liability for the business and you are paying interest, that will automatically give you the leverage that fine, you can show this interest as an expense, and accordingly your earning before tax will be reduced.
Yes.
So what the companies are doing, companies are taking up this debt capital for this one reason also.
Yes.
They are getting the benefit or the leverage of, you can say, paying off interest as an expense, and thus reducing down their earnings, taxable earnings. So on the one side, they are having this benefit of reduced taxable earnings, and also, let me tell you that you can compare it with the market informations that the debt capital is comparatively cheaper if compared with the equity, because equity capital bears more cost as compared to debt. So if you are taking up loan from the financial institution or banks, that will cost you less as compared to the equity or the shares. Yeah. So that is the reason why usually it has been recommended that your capital should be the mix of both the sources. It should not only be having the debt, or it should not be the equity totally. It should be the mix of both the sources of capital so that you can take the benefit of debt also. And yes, of course, you should have equity also in your capital. Because one very important point here, that interest, though it is of low cost, but yes, it is a fixed financial obligation that each and every firm will be bearing if they have debt in their capital, which you cannot spare. So if interest is there, you have to bear it. There is no you can say bar from that. So that gives you a fixed financial obligation. Yes, anyone who is not here at the same page with me, or any doubt in the previous, you can say, discussion? Anyone? So moving ahead, now, just a brief revision. What we have been doing, what is the flow of the income statement? Because this is very important for the understanding of financial statements, that how we are preparing the income statement. We start the income statement in the vertical format with the help of revenue, with the help of sales, plus other income if we have any. We add up, we'll get the total income. From that total income, first we have to reduce down the cost of goods sale that we are selling. So cost of goods sold means whatever direct expenses directly related with production, if you are spending, that all need to be calculated and reduced from your total income. This will give you your gross profit, but still the gross profit is not the indicative figure for the profit. So we further reduce down this gross profit with other expenses in the form of selling expenses, in the form of administrative expenses, advertising, marketing, research and development. After considering all these expenses, what we get is EBITDA. From EBITDA, we need to reduce down depreciation or amortization expenses. Then we'll get EBIT. EBIT is considered as a fair, you can say, parameter to assess the profitability, because iske baad we consider the interest only. So earning before interest and tax can give you an idea about the profitability of the business. Then reducing the interest that we are paying on the debt capital, we get the earning before tax. And this earning before tax, we need to pay the tax amount. So whatever is the tax rate, 30%, 40% applicable, depending upon the policy, depending upon the norms of the country. Then we pay the tax, and whatever amount that is left after paying the tax, that is considered to be your after-tax profit, which is supposed to be the final figure for the profit. So after this profit after tax, now this is the profit which is available for the shareholders, for the owners of the company. And this profit need to be further, you can say, distributed, as we have discussed in the previous slides also, that this need to be distributed among the equity, among the shareholders. May it be the preference share, may it be the ordinary equity shares, right? So this profit will have two parts again. One which is distributed, which has been already paid to the shareholders in the form of dividends, and the other part which has been retained by the companies. Okay. So now in this case, I wanted to share with you live, you can say, me.
Hello.
Rahul, are you there?
Hello.
Yeah.
Hello, ma'am. Am I audible?
Yeah, Rahul, you are audible.
Yes, ma'am. Should I share the screen again, ma'am?
Just a second. I'm downloading the format.
Okay.
Is the screen visible to everyone here?
Yes, ma'am.
Now you can see here, I have taken up example in the form of example, the Tata Motors. You all can see the income statement, profit and loss account, right, of Tata Motors. And whatever we have discussed, you can utilize that information in assessing this particular profit and loss account. So see, we have taken revenue from operations, which is nothing else but sales. Then revenue, net revenue we have calculated after considering all the taxes, etc. Then total operating revenue, and then other income we are adding. So this is the, you can say, total operating revenues and other incomes we have added up to get the total revenue of the business. This is the total income. And then out of total income, you can see here the expenses we are reducing. Yes. So this is nothing else but, see, cost of material consumed, purchase of stock, operating and direct expenses we have considered here. So these all are the different categories of expenses that we need to show here. Employee benefit, then finance cost. Finance cost is your cost related to raising capital. Then depreciation and amortization expenses, other expenses. So we are having total expenses. Profit or loss before tax we have calculated. Before tax is your earning before tax, EBT, what we have discussed. And then comes your tax part. And you can see here after tax, it is profit and loss for the period. After profit and loss, you can see here the basic EPS. EPS is earning per share. Earning per share means whatever the company is distributing in the form of EPS or earning in the form of dividends, we can say, to put it more simpler. So this is the you can say example that how you need to assess the income statement for any of the businesses, any of the, you can say, units. So it starts from the revenue from the operations, taking up all the revenue, including other income, then reducing down all the expenses, then putting up tax on it. Then after tax income that needs to be distributed in the form of dividend. So we are diluting that income in the form of dividend, and then ultimately we have the dividend and the reserves if the company is keeping on in. Rahul, can you share the PPTs again on the screen?
Yes, ma'am. Just give me a minute.
Ma'am, can you able to control?
Just a second. Balance sheet also. So please allow me to share the screen again. Now you guys can see the Tata Motors balance sheet also. I hope it is visible to everyone. Yes?
Yes, ma'am, it is.
Is the basic balance sheet or the standalone balance sheet, is there any difference?
Yeah, standalone balance sheet is the balance sheet which talks about one particular company. And when we talk about the consolidated balance sheet, so it is the balance sheet which shows the overall valuation of the company, including all the subsidiary companies also. Means, let's say company A is there. So standalone balance sheet will give you the details of company A only. But let's say company A is holding B and C also. So consolidated balance sheet will give you the total valuation of A, B plus C. So A, who is holding B and C, so A plus B plus C. That is consolidated. And standalone means it is showing you only the particular company's financial statement, financial position. Yes. So now you can see here, it shows the equities and liabilities first. It is telling you that whatever is the company's liability towards shareholders, and you can see here equity share capital, then total share capital, then reserves and surplus. So this is what the reserves and surplus we are talking about as the retained earnings, which have not been distributed. Now you can see here that there is a lot of funds available in reserves and surplus for this particular company. So this reserves and surplus will be utilized maybe in the future for the further, you can say, investment again in the business or for any other investment purposes, which will ultimately, you can say, give benefits to the company. Then comes your, this is about the, you can say, long-term shareholders funds. Then comes the non-current other liabilities, which is, you can say, your debts will be there, long-term provisions if we have any debts in the form of that we have discussed in the previous slides. Like if you have any capital from the borrowed funds, then that borrowed fund is being taken up. So all the, you can say, long-term liabilities, non-current liabilities need to be taken first, maybe equity part or the debt part. Then comes your current liabilities. Under current liabilities, we have number of liabilities in the form of, you can say, which we need to pay within 1 year. Let's say trade payables or other short-term, you can say, liabilities that we need to pay off. And then comes your assets. In assets also, as we have discussed previously, that we have two categories of assets, the non-current assets or the current asset. Non-current assets is Whatever we are holding, or you can say, rather to put it better, whatever the business is holding under long-term assets, which is there with the business or expected to be there with the business for more than 1 year. So all those assets need to be considered here. And then comes your current assets, which tells about the position of the business in the you can say in the form of short-term holdings of the business, like what the business is holding, or indirectly we can talk about the working capital also with the help of current assets. That it shows, it gives you an idea that what the business is holding in the form of working capital. Because all these current assets need to be adjusted, or need to be, you can say, need to have the life of not more than 1 year. So that is giving the business a fund, a source of fund which can be regularly utilized for the business. Like from, let's say, you are having cash and cash equivalents. So that is being regulated in the business, regularly used in the business. Or you have, let's say, trade receivables. So these trade receivables are nothing else but what is due need to be paid by your vendors in the form of maybe credit sales that you have done, right? So you are expecting certain payment from your vendor. Now you know that this particular vendor will be giving you this amount at this point of time, and this amount will be utilized in future for this particular purpose. So you have that working capital in hand with you with the help of these current assets, which can be utilized for rotating the money in the business for the operations. This is how your balance sheet looks alike. Starting from your long-term liabilities, then your current liabilities, then non-current assets, and then current assets. Any doubts or anything you need to ask here? Anyone? Now, after this comes your cash flow statements. Rahul, request you to
Yes,
share
yes.
the screen. Yeah. So, cash flow statement, as we all know, you must be having an idea that what does the cash flow talks about? Anyone? See, when we talk about the cash flow statement, beyond this slide only. When we talk about cash flow statement, see, there is a vast difference between the profit that we are calculating and the cash we are holding, right? It is not necessary that if the company is showing good profits, the cash position is also good. The ones who are already having their startups running, they will be in a better position to relate with this thing. I hope yes. Yes.
Yes. So it means that our balance sheet may be showing healthy this thing because of our fixed assets.
Exactly.
Not the daily cash that comes in.
Right. Maybe your funds in the working capital is not appropriate or is not much, but yes, your business is showing good profits. Maybe, for example, let's say you are doing 90% sales on credit basis. Let's say, for example, right? So your 90% sales are on credit basis. So whatever you can say you are getting in return against your sales in the form of cash is only 10%, and rest 90% will be adjusted later, maybe in a month, 2 months, 3 months, 4 months. So what about the cash position? Your profit is high for that particular quarter, let's say, but your cash holding is not that much appropriate. If you can, if you need certain funds for business running, you may need to a cash crunch.
Yes.
So profit is one parameter to assess the performance of the business, but having good profits does not always mean that there is you can say liquidity in the business.
Mm-hmm.
And if you could relate it with the very classic case of kingfishers, you will be able to analyze the situation in a much better way.
Yes, they didn't have money to pay their employees.
Exactly, but showing heavy profits in their operations. So from that, it has been realized and made mandatory with the new, you can say, guidelines that no, along with the income statement, along with the balance sheet, you also need to give cash flow as one of the mandatory statements. Because profit is one aspect where we consider cash and non-cash item both, right? But cash flow statement will clearly depict the picture that what is the cash inflows and what is the cash outflows for the business, to understand the liquidity position, that whether the business is able to generate the required level of cash or cash equivalents or not. So that it gives an idea about the business, that whether the business will be able to meet out their operating, you can say, functions on the day-to-day basis or not. Because हो सकता है profit बहुत ज़्यादा हो, but आपके पास cash ही नहीं है, how you will be able to pay off the salaries, how you will be able to meet out your day-to-day expenses if you are not having sufficient amount of liquidity in your business. You are performing good in terms of profits, but you are facing cash crunch in your business, which may lead to bankruptcy at the end. Right? And this is, we can relate this situation with Lehman Brothers also. Again, a classic example for this. So it is always necessary, if you want to assess the performance of the business, if you want to have fair information about the you can say performance of the business, along with the income statement, along with the balance sheet, you should also know the cash flow statement, which reflects the cash position. So, since time is not allowing me to go any further, otherwise we could have discussed in detail about this cash flow statement.
This cash flow statement, how do we make it? Just it's to be made on daily basis?
No. You can define your cash flow statement as per your own requirement, that you can do it on the quarterly basis, you can do on the monthly basis also. But yes, when you are disclosing your information on the public platforms, like if you are a listed company, you need to disclose your income statement, balance sheet, and cash flow for the year. All the listed companies, they follow this pattern that they have to disclose their financial statement, all these 3 financial statements publicly. That should be on the yearly basis. And for your own purposes, you can prepare it on the monthly basis also.
Okay. Do you have an example of this cash flow statement?
I was thinking of discussing it with you. See, when we prepare the cash flow statement, we divide cash flows like incoming and outgoing under 3 different heads, which is considered to be the 3 different areas of business. One is from the operations, whatever cash you are getting from operations or whatever cash you are paying for operations of the business. Other is the investments, like any, you can say, investment that is giving you cash in the business, or any investment for which you are paying cash, right? Majorly it is for the fixed assets, like from any fixed assets if you are generating a certain cash, or for purchase of any fixed assets if you are paying back the amount. And then comes the financing activities. Financing here means that any of the business, if generating capital, then in that case, it is getting certain cash. And in case of any, you can say, any outflow because of financing, means suppose you are, let's say, issuing shares, then you are receiving money. And if you are buying back that share, you are paying back the money to the shareholders. So that will be the form of cash outflow and inflow. Right. So whenever you are assessing the cash flow statement, what you need to do, you need to classify these statements under three different heads. One is cash coming or going through operations, other the cash coming or going through investments, or the cash you can say coming and going through financing. Right? So these are the three major criteria that we need to assess, and based on these, we prepare the cash flow statement. If any future session allow me, then definitely I can take up this in detail.
Pallavi, please mute yourself.
If you want, I've taken up certain notes here. I can provide this to you. This is the pattern we can follow for a cash flow statement. How we can do the adjustments.
Thank you, ma'am.
Rahul?
Yes.
If any doubts are there regarding these things, we can discuss it. And I hope maybe in future, if I get certain time, then we can take up the things.
Sure, ma'am. Thank you very much. Thank you for taking out time. Participants, any doubt you have, quickly we can discuss, else we can close.
Yeah, I can share the mail ID, Purnima. Rahul, can I do it right here?
Yes, ma'am. You can share with the participants. No problem.